I've seen it 1,000 times. Your mate down the pub tells you about this hype new investment that he's put a few grand on. He's absolutely buzzing, convinced it's going to make thousands of pounds in the next month or so. It's going to the moon, he says, especially when they announce their new game-changing tech. So, not wanting to miss out and dreading the I told you so at the next night out, you throw in all of your life savings. Over the next few weeks, you're glued to your screen watching the price fluctuate, wondering why they haven't announced it yet. Finally, the company schedules a press conference for the next morning. Your mate's WhatsApp group is going absolutely wild. This is it. It's finally happening. The following morning, you're all glued to the live stream. You're unable to sleep or eat and having barely interacted with the world outside for a few weeks now. The stream goes live. The CEO walks onto the stage and he says, "It is with great regret that our new technology has failed in final testing and will be delayed by a minimum of 2 years."
I've got nothing left.
The world feels like it's imploding. You frantically try to log into your investment account, but the price is tanking, dropping lower and lower. Finally, you can't take it any longer and you sell at a huge loss. And you now face the humiliation of that one friend who told you not to join in. He's the long-term investor. You're done by this point. No more investing. Your dreams of living a Lambo life in the south of France evaporate. But this might be a fictional story, but I can't tell you how many of my friends have lived through similar scenarios. Trendy, fast money has the allure of getting rich quick. I'm not gonna lie, sometimes it pays off. But more often than not, you're left holding the bag. Trendy investments, also known as speculative or hype investments, are those that suddenly gain immense popularity, often driven by social media, online forums, or sensational news stories. They promise quick, substantial returns, attracting a lot of attention and money in a short period of time. Media hype, the fear of missing out, or FOMO, play a massive role in their appeal. So in this video today, we're going to unpack trendy investments and how I build real wealth without getting involved in the hype. In early 2021, Gamestop, a struggling video game retailer, became the center of a financial storm. Its stock skyrocketed from under $20 to over $400 within weeks. But how did this happen? At the heart of the GameStop saga was a subreddit called Wall Street Bets, as well as a YouTuber named Keith Gill, or the Roaring Kitty.
It's all about tracking. Just follow what they say.
This online community on Wall Street Bets was known for its high-risk investment strategies, meme culture, and this played a pivotal role in the stock's meteoric rise alongside Roaring Kitty. Hedge funds had heavily shorted GameStop, betting that the stock price would fall. And basically, these guys noticed this and they started buying GameStop shares en masse and encouraged others to do so, which caused the price to rise back up. It was basically a stand against the system, they called it, but in reality this happens every day. Hedge funds short companies that are underperforming, just as GameStop was. As the stock price soared, more retail investors, people like you and me, jumped in, driven by the fear of missing out on the massive gains. Then the story gained widespread media attention, fueling further buying frenzies, and the hedge funds that had shorted GameStop actually faced huge losses as they scrambled to buy back in at higher prices to cover their positions, which drove the price even higher. Look, some made substantial profits, but many others bought in the peak and suffered significant losses when, of course, the price eventually crashed. Next up, we're going to talk about meme stocks. Now, what actually are meme stocks? Meme stocks are shares of companies that gain popularity again through social media and online communities rather than through traditional financial metrics. Wall Street Bets, who we were talking about before, is pretty much the main driver of meme stocks and were pretty prolific in 2021 and 2022. Now, the community is known for basically frequently sharing these memes and these high-risk investment strategies. Example of these meme stocks include AMC Entertainment, BlackBerry and Nokia, which saw huge surges in stock price as retail investors jumped behind it. The thing is, these types of investments include many cryptocurrencies as well, like Dogecoin. The problem with this is that there's no real value, and it's simply hype, FOMO, and a bunch of money all coming together. The GameStop saga and the rise of meme stocks demonstrates the allure and danger of trendy investments. While their potential for quick gains can be very tempting, these investments are marked by extreme volatility and high risk. Understanding these dynamics can help you make more informed decisions and avoid the pitfalls of chasing the latest investment fads. So what about my own strategy? Now, luckily for me, I was introduced to investing before the hype years of 2021 and 2022, so I was nicely positioned to have a little bit of fun, but without risking it all. Now, thanks to a handful of books and some skin in the game, I'd built a more reliable approach to building my wealth. But what does that even mean? Well, enter the 80-20 strategy. It's simple, it's effective, and it keeps me grounded. Here's how it works. 80% of my investment goes into buying and holding index funds each month. These are the backbone of my portfolio. They're relatively stable, nicely diversified, and built for long-term growth. The remaining 20%, that's reserved for individual holdings like stocks, some cryptocurrency, and although I keep this relatively small, between 3 and 5%, and within that I keep another 5% as well of my total investment in cash inside my investment account. I can hear you going, well, why would you do that? Well, I know my limits and I also understand my risk tolerance. We all have different levels of risk that we're actually comfortable with. Some people can handle the stress of watching their investments swing wildly while others prefer a more stable approach. It's important to find a balance that suits you, your personality, and your financial goals. Risk tolerance is totally unique to each individual. It's influenced by factors like your financial situation, investment experience, and even your personality. By understanding your own risk tolerance, you can make more informed decisions and avoid the emotional roller coasters that come with high-risk investments. But why 80% in index funds? Well, because they're like the workhorses of the investment world. They track the market, provide diversification, and historically, they perform better than most actively managed funds and investors. Let's break it down. An index fund is designed to replicate the performance of a specific index, such as the FTSE 100 or the S&P 500. They're the most famous. It's essentially a list, and the fund is the vehicle that allows you to buy that list. By investing in an index fund, you're buying a small piece of every single piece of that company inside that index. This broad diversification reduces risk because your investment is spread across many different companies and sectors. Over the past few decades, numerous studies have shown that index funds consistently outperform the average active investor. This is because actively managed funds often have higher fees, and their managers frequently buy and sell stocks in the attempt to beat the market. This active trading incurs transaction costs and can lead to poorly timed decisions too. On the other hand, index funds typically have lower fees because they simply aim to match the market's performance. They're passively managed, meaning there's much less buying and selling, which reduces the costs and the impact of market timing. Think of it like the story of the tortoise and the hare. The hare, like the active investors, tries to make quick gains but often burns out with poor timing and high costs, and the tortoise, representing index funds, moves steadily and consistently, ultimately winning the race. Even legendary investors like Warren Buffett recommend index funds for most people. Buffett has famously said that for most investors, consistently investing in a low-cost S&P 500 index fund will outperform most active investments over the long term. He's so confident in this approach that he's instructed his estate to invest 90% of his wealth in the S&P 500 after he passes. Now, I don't know about you, but I think I'm going to follow Warren's advice over these meme stock channels like Wall Street Bets. So what about the next 20%? Okay, let's dive deeper into the 20%. This part of my portfolio is where I allow myself a little bit more flexibility and the potential for higher returns, but I do it with caution and a clear strategy. For the 15% that's invested in individual stocks, I focus on the fundamentals. This means doing my homework and thoroughly researching each company. I look at financial statements, assess the quality of the company's management, understand its competitive position within the industry. I'm not just buying stocks, I'm buying pieces of businesses that I believe in and that could have strong potential growth over the long term. Now look, if you're a beginner, I know this might sound overwhelming, especially if you're just starting out, or if you only invested a small amount so far, but don't worry, you can begin with just a few simple steps that I'll run you through. Step number 1, start small and simple. You don't need to buy a lot of stocks at once. Begin with 1 or 2 companies that you can understand and believe in. This could be a company whose products that you use and trust every day. Step number 2, just look at the basics. Instead of diving into deep, complex financial reports, start by looking at the overall health of the company. Is it a well-known brand? Do you see people using it and its products or services? These are good signs that the company is doing pretty well. Step number 3 is stay informed. Read news articles and analysis about the companies that you're interested in. This will help you understand their market position and any upcoming changes or challenges that they might face. Step number 4 is diversify. Even within your 20%, try to spread your investments across different sectors and industries, and this will help you reduce risk. And remember, it's okay to keep some cash on hand for those unexpected opportunities. I currently hold 21 individual holdings. For me, this is kind of a good number because any more and it gets a little bit hard to track. Between 15 and 25 is a good number to manage in my opinion. Now, step number 5 is educate yourself. Read books, watch YouTube videos, and dive into some podcasts. However you like to learn, just add 1 or 2 bits into your weekly entertainment. Honestly, you'd be surprised at how fast you pick up what you actually really need to know. Now, moving on to the more smaller slice of my higher risk investments like cryptocurrencies. I keep this between 3 and 5% of my total investment, and I try never to go above that because cryptocurrencies can be highly volatile. But they do offer unique opportunities for some significant gains too. But by keeping this portion of my portfolio quite small, I can enjoy the potential upside without exposing my entire portfolio to some excessive risk. And let's not forget the 5% that I keep in cash within my investment account too. This cash reserve is crucial for seizing unexpected opportunities. Sometimes the market presents a grossly underpriced company or an undervalued sector, and having cash on hand allows me to act quickly and capitalize on these opportunities without having to sell other investments at an opportune time. This 20% overall allocation that I have here lets me have some fun and explore some higher risk opportunities, but it's done in a controlled and thoughtful manner. By keeping the majority of my portfolio in index funds, I ensure that my financial foundation remains pretty strong, and it allows me to have some growth and exploration within my risk tolerance, personal to me. So next up, I think a good idea for you is to dive into how to invest your first £1,000, which has just popped up on screen now. If you're not a beginner and you want to know more about index funds, then there's a video popping up about that now too. I really enjoyed this one, and I'll see you over there on the next video.